Welcome back. This is the final of our tutorial videos that I will be providing, and this will focus today on reporting system, the reports that give you the information you need to make good decisions. So the very first report we're going to review is known as the Footwear Industry Report. The Footwear Industry Report is actually the very best place to begin before you make any strategic choices or any operational decisions. So this report actually contains 8 pages worth of information. Everybody gets to see all of this information. All competitors have the exact same report here. And the 8 elements, we have our scoreboard, our earnings per share, return on equity, stock price, which is part of our score, credit rating and image rating, which are also part of our scoring. Then we get into the details, an overview of what the industry is doing currently, financial statistics of all of the different companies, production benchmarks across the globe, as well as operating benchmarks. And then we'll get into the celebrity bidding and price trends for all of these as well. So let's get into an actual report. So here we are in the Footwear Industry Report. We access it over on the same area we did our decision screens, but we go a little bit further down. And on the first page is our scoreboard. The scoreboard is broken into investor expectation and best in industry. If you remember, the investor's expectation, this is a score where everyone can get as many points as possible. What that means is that there's 100 points to be had, 20 points per category. As long as you reach your investor's expectation, you'll score that 20 points for each of the 5 criteria. If you exceed your investor's expectation, you'll get above 20 points with a maximum of being 22 points. And that is why you can see some scores on this side are over 100 points. The best in industry scores, these scores are relational. So only one person can get the maximum points in each of the criteria because there can only be one best in industry competitor. So in here, we see that Fierce Footwear is ranked number 1 as the best in the industry. The rest of the points are then distributed based on how close they are to the best in the industry. So what I see is I see a dramatic drop between number 1 and number 8 from 91 to 50. But I see that these 4 companies near the bottom, 4 through 8, are actually all pretty close with best in industry. So they're competing pretty closely. Remember, this is for practice year 12. We have no idea what people were putting in. Some people were putting in random numbers. Others were trying to be strategic. Others were just trying to see what the system would do. So I would not put any weight into how good or bad any of these scores look like for our industry. And then it gives a weighted average. For this simulation, the weighted average is simply an average of the 2 scores. We take each of them is weighted equally. So this is the year 12 scoreboard. We'll then have a game to date scoreboard, which is your overall score as we go on. And we can see different scores here. Again, investor expectation versus best in industry. And at the bottom, you can read a little bit of detail as to what each of those scores mean. And then we have overall game to date. Bonus points is for when you do something that is extraordinary. Maybe you're most improved, or maybe you have surpassed all of the expectations of the investors. So this is just our overall score. Let's get into the scoring criteria. Please note, I've given you a document that breaks down the scoring criteria in the From Your Instructor section, so you can go there too. So page 2, this shows us all of the scoring measures. This is how we're evaluated within the simulation. The first is earnings per share. This shows us how profitable our business is compared to the owners. So here, what I see is year 11 all the way through year 20, which is what our competition will do. If I look below, I will notice that there is a section that's in parentheses. This is your investor's expectation. So for year 11, your investors expected an earnings per share of $2.50. We'll notice that only one company was able to exceed that $2.50, and therefore their number is bold. When we see the highlighted number, that means that this company was the best in the industry. So for year 12, I can see that the investors expected earnings per share to go up a little bit to $3 per share. And I see that 3 companies were able to meet their investors' expectations, with one company, of course, being best in industry. And then we give our weighted average, our year 12 score. How does this translate into points in the simulation? So over here, F company had a earnings per share of $3.97. It exceeded investors' expectations, and it was best in industry. Because it exceeded the investors' expectations, scored 24 out of 20 points. And because they were best in industry, they scored 20 points. What you'll notice here for A company, in year 11, not so hot, but in year 12, man, their earnings per share went up a lot. And so I can see them being rewarded with 22 points. And best in industry, not quite. So 20 points was best in industry, but they definitely were second best. And then we combine those for a gain-to-date score. So this is simply for earnings per share. The next of the criteria is our return on equity. How well are we paying back our shareholders? So here, return on equity shows the same type of items. What is the percentage that the investor expects? In this case, 21%. In year 11, only one company was able to hit that mark. By year 12, we have 3 companies hitting that mark, with one company leading the way. And then we see the scores are represented over here as a result of these outcomes. We also look at stock price. What is your stock price? This is the relative strength of your business as rated by the people that are willing to buy a share of stock. And again, we have best in industry versus investor expectations, and you can see the investors' expectations up here, and then the scoring criteria over here. You want to pay close attention to these because this is how you are graded in this class. You are graded on your investors' expectations and your best in industry scores, and those are determined by these criteria. First, earnings per share, return on equity, and stock price. We then have your credit rating and your image rating. Those are also factored into your grade as far as the simulation is concerned. For credit rating, pretty easy. We see that many people were able, in year 11, were able to satisfy their investors. And we had 2 companies drop off here in year 12, not meeting their investors' expectations. And then we see best in industry investor expectation score here. Image rating. This is what is your company seeing as the image of your consumers, which would also include your retailers. And this is a score, can go all the way up to 100, but the investors expect starting out at 70 and ending at around 80. And you can see where your relative image scores are here. Also on the footwear industry report, in this one, we have corporate social responsibility and citizenship. What this does is it does improve your image rating. So image rating is on many criteria. However, it breaks it down to show you specifically how your social responsibility and corporate citizenship factor into that score. And it'll give you an idea of how much people are spending and how many actual points they're getting as a result of their social responsibility. And then there's also the Corporate Responsibility Award for exemplary corporate citizenship. There are bonus points. I mentioned that before. You have two types of bonus points. Bullseye Award. Based on your estimate of the relative competitiveness of your competitors, or how are they aggressive are they going to be compared to your predictions. This is within the decision screens. How accurate are you on your forecasting? And then how well did you do from year to year? And then we call this the Leapfrog Award. And you can get bonus points for that. We then jump into the details of the footwear industry report. We're no longer on the scoreboard. So here, I will allow you to read through all of these, but I'm going to briefly give you an idea of what it is you're looking at. First is an industry overview. You had estimates when you were making your decisions, but since the industry and the year is already run, now we can see what the realities were. And you'll notice that base price of materials, $6, but we expect that in year 12, our standard materials are going to cost $7.29. And superior materials, the price is actually dropping a little bit. And it gives some notes and details as to why you can expect those changes in year 12. Give you an idea of our demand, footwear production and sales, the demand which was forecasted and actual for each of the regions. And we can see how many companies had stockouts in the different areas, and of course notes for each of those. You want to pay very close attention to demand. Demand is telling you how many shoes are expected industry-wide. Make sure you're not making too many or too few. And this outlines the global demand, but in each of the different marketplaces. This is not your company. This is for all of your competitors. Facility space, this tells you who may have built facility. I see that E and F company expanded by building facilities in Europe and Africa, as well as Latin America, through the construction of new space and the changes in production equipment also. Very important information as you're trying to make decisions related to your competition going forward. Page 5 has to do with financial statistics. We have our income statement. You may want to review the elements of an income statement so that you can understand what all of this means. This is extremely important to especially your earnings per share and your return on equity scores, measurements which you're graded on. So you may want to review how to read an income statement. The same thing with the balance sheet. This will definitely go with the return on equity part, understanding where you are as far as the return for your shareholders. And then there's other dividend, profitability, and credit rating measures here at the bottom of this page. Production benchmarks. As we go through production benchmarks, it will give you an idea of your labor, the new equipment, and it'll break it down per region as to what you have in each region as an industry. This is the industry, and then it'll compare your company to that industry. So for example, total regular compensation per worker per year. The lowest in the industry was paying about $36,000, and the highest in the industry was paying about $44,000. Company C was somewhere about average, a little bit higher than average at $42,000, whereas average was about $41,800. So this gives you an idea of where your company falls within each of these elements. Another one to look at is reject rate. The best reject rate in the industry is only at 4.3%, with the worst being at 7.9%. This company, Company C, has almost 7%. So they're higher than average, which means that their quality control is not quite as good as it should be. Might be something you want to pay attention to. Also note, on every screen, I can change the footwear industry report to go back and see what it looked like in years past. There's also help and a video tutorial on each of these screens as well. Page 7 are our operating benchmarks. The operating benchmarks, again, low, average, and high for our industry, and then we can see our company compared to the industry with each of these performance benchmarks. And it also includes private label. The one that a lot of people find interesting, of course, are the celebrity endorsements. So here I see that there were definitely offers for many of these celebrities. It will show me the highest offer, the second and the third highest. What I see here is that for Bronco Mars, B company offered $670,000, whereas A company only offered $501,000. Therefore, we see that Bronco Mars went to B company as far as they won the bid on that company. Down here, it's interesting to see that A company had offered Roger Federation $501,000, but E company won the bid, very likely because A company had set themselves a spending cap, and so this would have went over their spending cap, and therefore Roger Federation went to E company as opposed to A company. Down here, we see charts that give us an idea of where the pricing and service qualities are going. What I notice here is service quality in North America went up significantly. Wholesale price stayed about the same, and internet price stayed about the same. And we can see that for each of the different marketplaces. Our next set of reports are called competitive intelligence. Competitive intelligence, what they are going to do is give us an idea of how our competition is doing compared to us within the marketplace. Now, the footwear industry report did that a little bit, but this will dig a little deeper. So we'll have comparative competitive efforts. This one is going to be a vital report, regional competitive efforts, as well as time series competitive efforts. So let's go ahead and get into each of those. So under competitive intelligence, the first one is comparative competitive efforts. Let's see how this screen is laid out first. You have up here, I can change the region that I want to go to. Over here, I can change the company that I want to evaluate. And over here, I can change the year that I want to evaluate. You may also find it helpful to print different reports, especially ones that you're particularly interested in. And again, there's of course a help screen. So here, our comparative competitive efforts, it shows all the companies across the top. It'll then show the industry average for each element, and then this company versus that industry average. So here, we'll just take a look at, this is the internet segment, of course, the retail price. Looks like everybody charged exactly the same retail price, no difference. I actually take that back. We have company E charged $1 more. Free shipping, no across the board, search engine advertising prices, all of that. And then we see market share for each of these competitors. And then we're going to come down to the wholesale segment. What's going to really stand out here are things that you see that might be highlighted. So let me get to what these highlighted items might mean. I'm looking here as I'm looking at my wholesale segment. And then I see the number of pairs that have been demanded. This is how many pairs of shoes your consumers want, or your retailers want to purchase. So here, for company B, what I notice is that there was 1,881,000 pairs of shoes that were demanded. However, you're only able to sell 1,809,000 shoes. A loss of 72,000 shoes in sales. Well, why might that happen? That's likely going to happen because you either were not producing enough shoes in order to satisfy that demand, or you were not able to get the shoes to your retailers in time and therefore having stockouts. That is not a good thing, because if we notice this loss of 72,000 shoes, well, if I went to the shoe store and wanted to buy a pair of shoes and the ones I wanted weren't there, or there simply weren't your pair, weren't on the shelf, I'll just buy somebody else's pair of shoes. So unless I really wanted only your shoes, I probably chose someone else's. And in this case, that's exactly what happened. So I see that company B lost these shoes and company A was the benefactor. They gained from that loss. And I also see here company F lost some shoes, whereas other companies were able to gain as a result of that. It then gives me the relative market share for each of the competitors. And I can see here, company C versus the industry average actually is selling 15% fewer shoes than their competitors, and they're actually lost about 2 points of market share. That's probably not a good place to be. So how can I figure out where my customers are? What should I be doing? Down here, these charts are very helpful. Now, I'm not going to focus on internet segment. It's kind of small. I'm going to focus on wholesale segment and this graph. What this graph shows me is it shows me, first of all, how big is my product line? How deep does it go? So do I have very few models of shoes, or do I have many, many models of shoes? On this side, I'm going to take a look at my relative price and the quality of those shoes. So here I would have a low price, low quality type shoe. Up here I would have a higher priced, higher quality shoe. And so as we go across here, more models, more availability, and here we get into the price versus quality. I then see a whole bunch of circles. And what do each of these circles mean? Well, each represents a company. So we see A company, F, E, B, and there's a few that I can't even see on here, so they're hidden in the back. So if I look for company C, I really can't see it at the moment. What this shows is where each company is producing. So if I take a look at company A has a relatively higher price and a relatively higher service quality rating, and they have just slightly less than average as far as the number of models that they have to provide. The size of their circle gives me an idea of their relative market share. So they're capturing an okay market share in this part of the demand area. Over here I see company F. Company F is offering more models, and it looks like at about an average price and average quality. And they have a pretty large market share. And then notice company G and company H. Company G and H look like they're head-on competitors. They are competing for the exact same customer. Someone that wants a fair amount, but not a lot of different types of models. And they're looking for probably a lower price and lower service quality. Well, they don't have much market share. So either they are stealing from each other as far as their customers go, or there's not that many customers that are in this market demand area. Company E not doing too bad. They are offering a low price, lower quality, and about an average number of models. Company B is kind of stuck in between company E and F. So people are deciding on either E or F as their preferred shoe provider, whereas people don't really want B's product. They're either too expensive for the number of models, or at their price range, they're not offering enough models. So somewhere E and F is beating out B. And I don't see C or D, or I think that's at C or D even in here in this area. So they are probably being overshadowed by company F is my guess. That's what's happening. So this is a very important piece of this report. Okay, next we get to regional average. This will just break it down for each market segment, a little bit more specific. And as we look down here, I will see some of the trends. I will see that the average internet price, average wholesale, and average service quality rating in this region. And I can change the regions by changing that up here, and I can see any differences. And then finally, we will get to time series, and this is just over time, year 10, year 11, year 12, and how company C in this case has changed. If I want to change it to company F, and I want to see what they're doing in North America, I can see what company F has done in North America. If I want to see what company A has done in Latin America, I can see that as well. Okay, finally, we'll get to performance highlights. Performance highlights gives us year-over-year highlights of different elements of our competition. I'll let you look through this on your own. We get to company operating reports. We have facilities and equipment. So it shows us our facility space. One thing you need to be aware of, and that is the depreciation of your equipment. Know that your equipment will go obsolete. When your equipment goes obsolete, you will no longer be able to produce at that production facility. Therefore, you need to make sure that you have either invested in new equipment or have upgraded your equipment to increase its longevity. Either way, you do not want to fully depreciate any of your equipment until you have replacement equipment. We then get into production and workforce, production statistics, our distribution and warehouse, and so forth, marketing and admin, our private label operations. We'll take a look at our income statement. So it shows you for each of your 4 marketplaces where you are getting your revenues. So internet, wholesale, private label, how much revenue you're getting in each area, any exchange rate adjustments, and therefore your net revenue from footwear sales in each of the marketplaces. We then subtract out our costs so that we can see where our profit is. We then see our profitability down to the earnings per share, and then we have the entire company over here as well. It breaks down our income statement a little deeper into our internet and our wholesale market performance. And then we have our balance sheet and our cash flow statement to wrap out our financial statistics, as well as many of our ratios. So if I'm looking for specific ratios, I will find them on this part of the report. So these company operating reports, these are only visible to you. You cannot switch companies. You cannot see what other companies are providing or offering. These are private reports. As far as competitive intelligence, everybody gets to see those, as well as footwear industry, and performance highlights are for your own company as well. If you really want to export anything, you can export any data that you might want, and you can also export any of those charts so that you can monitor things as they go over time. So let's just make sure we haven't missed anything here. So we had the competitive intelligence reports. The biggest one is this chart. We then get into our company operating or our performance highlights, which are year-over-year highlights, our company operating reports, which really focus. I would take a look at the income statement as well as your balance sheet would be probably the biggest ones you want to look at here, and those are your private reports. And that will lead us to our 3-year plan, which will be our last video, which I will go over when the time comes. Have a great week, everyone.